Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. On Thursday, Statistics New Zealand said the Consumers Price Index rose 6.7% in the 12 months to March. It's the fourth consecutive quarter that Consumers Price Index, or CPI inflation, has been near or above 7%, which is the highest level it's been since 1990. In its oversight of monetary policy, the Reserve Bank has a CPI inflation target of 1% to 3%. Thus, in an attempt to reduce inflation, the Reserve Bank has now increased its official cash rate, which is New Zealand's benchmark interest rate, by 500 basis points since October 2021 to 5.25%. So are the Reserve Bank's efforts to reduce inflation, including by engineering a recession, in Governor Adrian Orr's words, working? And are its tools, or tool, fit for purpose? To discuss this, I'm joined by Tim Hazledine, Emeritus Professor of Economics at the University of Auckland. Hi Tim, and welcome to the Of Interest podcast.
Hi Gareth, good to be here.
Firstly, Tim, what's your assessment of where the inflation fight is at following these latest CPI figures?
Well, I think the inflation tide is going out. It's receding, which is good. The question is whether it would have gone out anyway, or whether King Canute and the Reserve Bank had anything to do with it.
That's interesting that you say it's going out. One thing I did note, obviously that figure yesterday, that 6.7%, it's down from the last quarter. It's lower than most of the economists, or all the economists were forecasting. It's lower than what the Reserve Bank was forecasting. Yeah. But the non-tradable, or the domestic inflation figure, was 6.8%. which is the highest ever in the series dating back to 1999. So is that still not of some concern?
Well, I'd like to, of course, talk about the non-tradables, but just something on the actual headline numbers themselves, if I may. As you said, it's the 12 months to end of December. CPI went up by 7.2%. 12 months to end of March of this year by 6.7%. Now, you might think, well, that's only half a basis point. It's not a lot. But you've got to remember that the 3 months, second, third, fourth quarter of 2022 are in both of those numbers, right? So the inflation rates in those 3 quarters is included in the 6.7 and included in the 7.2, which means that to get a decrease from 7.2 to 6.7 overall, there has to have been a substantial decrease in the quarterly inflation rate of the first quarter of this year compared with first quarter of last year. And indeed, there has been. The first quarter of last year, prices rose by 1.8%. First quarter of this year by 1.2%. That's a 33% decline. And that's why I think that's the indicator that you really should be interested in, and that's encouraging.
Okay. And what about that non-tradable or domestic inflation? Stats NZ specifically highlighted higher prices for construction, rents, and ready-to-eat food.
Yeah, well, we'll talk about where it all started, this whole business of CPI inflation at rates unheard of for, as you said, 3 decades, a bit more. To me, what I'm going to suggest is that means that the Reserve Bank hasn't got a hope of doing anything about it, and we need to have other instruments to deal with any sort of entrenchment of non-tradable inflation.
Okay, that's fascinating, and we'll delve into that shortly. But let's just go back, I guess, a step from that, and I'm really keen to ask you, what, in your view, has caused this big inflation surge that we have seen over the last couple of years? What are the reasons for it?
Oh, the one big reason is COVID, I think. No, both directly on 3 ways. COVID, first of all, put a lot of people out of the workforce, reduced the supply side of the economy. It increased a lot of costs straight off, especially transportation, logistics costs, container rates, I think doubled or whatever, and that seems to have led to an increase in pricing pressure right through the economy internationally and domestically. And then COVID also, third thing, induced our governments to try and relieve some of the pain that being out of work or not being able to go to work was causing. And in the first, you said 2 years, and COVID is a 3-year-old thing now, and that first year in particular, our government and other governments stepped in with a lot of spending. They kept wage subsidies, all sorts of things, shovel-ready projects and that. And people are now saying, well, that maybe fueled demand inflation. So and that's a moot point still, how much demand inflation it caused. It didn't cause any demand inflation in the first 12 months. Now that inflation has turned up. Is it demand inflation, which is more likely to be responsive to interest rate changes, although not very much, or how much of it is supply push inflation of costs going up and profit margins going up and prices going up, excused, if you like, or justified in the first instance by COVID, but continuing despite COVID easing. So the COVID inflation, I think.
Okay. And COVID inflation and I guess the responses there to the virus itself and the pandemic. So you're talking there about what governments did in terms of wage subsidies, etc. What about what central banks did? What about the Reserve Bank here, obviously taking the OCR to that record low and keeping it there for a long time of just 0.25%, and also the quantitative easing, the buying of government bonds in the secondary market. Did those factors, how much influence did those factors have in your view?
I'm not sure about quantitative easing. It's moot. It's argued how much that is inflationary or was inflationary. Perhaps it was. They did try to help out with avoiding a recession, I think, in those first 2.5 years or so before they started bringing it up again, the interest rate. Whether that has any influence at all is just about as unknown as whether the turnaround, the about face, that has now taken up from 5 percentage points, the bank rate, as you pointed out, whether that's had any effect either. We don't know, and it's quite possibly hasn't. Remember that if inflation is demand pull, too much money chasing too few goods, then inflicting this pain, as you referred to, on the economy of unemployment, a recession, is reducing the supply of goods in the economy. It's throwing people out of useful work into going on the dole. So that can't be good at correcting an imbalance of demand and supply. Inflation also is increases in prices. And although it artfully is kept out of the CPI, the official consumer price index, for many New Zealanders with a mortgage, the biggest price they pay is the interest rate on their mortgage. And for me, that interest rate on the mortgages has more than doubled in the last year or so. So that by itself, that's a huge increase in the cost of living for many people. So you're going sort of 2 steps backwards in your Reserve Bank type monetary policy before you got much of a chance of making any progress.
It's interesting that you mentioned that. So, I mean, obviously, I have a mortgage myself, and our mortgage is a fixed term one, which most New Zealanders go for, and it's not up for renewal until December this year. So the OCR hikes and the subsequent flow through to mortgage rates hasn't hit me personally yet, so I have a shock awaiting me in December. So there is that sort of slow transmission of monetary policy through mortgage rates, but we did notice in 2 big business surveys this month, so the New Zealand Institute of Economic Research's quarterly survey of business opinion and MYOB's survey of small businesses, they did suggest that businesses are really now starting to feel the impact of high inflation, rising interest rates, and a slowing economy. So, do you think that there are signs out there that we are indeed going to have this recession that Adrian Orr talked about engineering?
Well, I'm afraid there are signs that it's going to happen, but what I worry about is that it's a horrible thing to do to the economy, to deliberately put people out of work. It's the most miserable thing one of the most miserable things that can happen to people is being thrown out of work. And to do that because you think they have to be it's more that obviously they're not going to be putting their wages up because they haven't got any wages anymore, but it's sort of to frighten the other 98% of people who are in work, or 96%, 95%, into not putting their wages up and perhaps frighten their employers into not putting their prices up. Well, it is, as everyone has said, a pretty blunt instrument and a painful instrument to apply. And I'm suggesting, and others are, I hope, that we should be looking for, to put it mildly, at instruments, policy instruments, which might assist the Reserve Bank. The Reserve Bank isn't asking for them. The Reserve Bank is quite happy to have a monopoly on anti-inflation policy, which it has by statute almost in New Zealand, but maybe they should, whether they want it or not, get some help.
Yeah, that's interesting, and we will come to that shortly. There was one other thing I wanted to ask you about before we get into that type of issue. Is interestingly, if you look overseas, and I'm particularly thinking here of a report I saw from the European Central Bank recently, where they said they're closely monitoring developments in underlying inflationary pressures that stem from both wages and profits. So that's interesting to me because I haven't noticed the Reserve Bank in New Zealand talking about corporate profits or margins and whether this is a contributor to inflation in New Zealand. Just wondering, to your mind, is there any evidence in New Zealand that it is? And should the Reserve Bank also be looking at or talking about profits?
I don't know if the Reserve Bank are the people to do it because it's just not on their monetarist model, but I think we should. I've suggested the Commerce Commission should have its mandate expanded to become a price watch commission, and even a price watch commission with a mandate to roll back price increases if they think, especially for non-tradables, they're not justified. However, I can't point to studies. I'm looking for them. You're right. I've seen the sort of things you've seen, sort of unease out there. I've seen the expression used, firms, big corporates discovering they have, quote, some real pricing power. And they're using it, Certainly, I think you mentioned construction prices. I think the increases that we've had in things like drywall for building and stuff, building material prices, look suspiciously like profiteering to me. As someone who's actually doing some building is having to pay them, perhaps I'm a bit paranoid about it. But so I think we need someone to actually investigate this. It won't be the Reserve Bank. It could be, say, the Commerce Commission.
That's an interesting one because obviously the Commerce Commission has been doing these so-called market studies in recent years.
Yeah.
Building materials was one, supermarkets was another.
Yeah.
I mean, we haven't seen a lot of action come out of those yet, but certainly those at the big end of town, the supermarkets and Fletcher buildings and perhaps the big banks do have market power. But what you're talking about would be the Commerce Commission looking more broadly across the economy.
Oh, and those industries you mentioned as well. But look, instead of the Commerce Commission has got a very limited model as well. They basically do things the way the Americans do it in their huge economy. They say, ask the question, are there any barriers to entry in this industry? So is there anything that stops competitors coming in, new competitors who would come in if the incumbents, the existing firms, were abusing their market power? If they don't find any barriers and they say, well, therefore the incumbents can't be abusing their market power. Well, in a country the size of New Zealand, we are always going to have market power. And we have a duopoly in home hardware thereabouts. We have a duopoly in supermarkets thereabouts. We have 4 big Australian-owned banks. Right through our economy, we're always going to have that probably because we don't have big enough markets in many cases to support a lot of firms. So barriers to entry are fundamental. They're the size of market, and the Commerce Commission can't do anything about that. What the Commerce Commission, I think, missed out on, especially in its big supermarket study, which came out last year, 800 pages, without ever really boring in on the possibility that the incumbents, Progressive and Foodstuffs, are abusing market power and charging too much money. They didn't. They said, they said something like, we couldn't find any evidence of collusion or parallel pricing. Well, they didn't look very hard.
And it's a case of maybe, from what you're saying, that you would argue that the Commerce Commission's mandate is too narrow. So how would you expand that mandate?
I would say they really have to be finding out about prices everywhere and investigating costs, investigating pricing practices. Of course, they should be looking out for conspiracies and things, but you won't find many of those. That these firms don't need to conspire to put their prices up. They just have to do what they did last year, and no one rocks the boat. So they need to get really sort of, I think, highlighting this stuff, making us angry, making the politicians angry, and then possibly doing something quite radical in New Zealand terms, having the power to roll prices back.
So this would be a case of really beefing up the Commerce Commission's power and resources and letting them really go for it, I guess.
Yeah, it might be. The Commerce Commission haven't asked for this, but I think they should be given something like that, yeah. Or we should at least be talking about that.
Okay. And back to the employment, or unemployment, both sides of the coin there. I mean, obviously, alongside the Reserve Bank's inflation mandate, they also have this mandate in their monetary policy for maximum sustainable employment. Now, this one, I find this personally quite a confusing concept because it's not a hard and fast figure of, maximum sustainable employment is 3% or 4% or 5%. It's based on a whole lot of factors that they weigh up in the economy. Is this, what's your take on this? What does maximum sustainable employment mean to you?
Yeah, that's a great question, and you're right to be puzzled by it because it does move around, and that's part of it. I don't know how much economic history you want here, but we had a revolution in economics 50 years ago. It was the monetarist counter-revolution. It was countering Keynesian economics. And they really went for broke. And whereas Keynesians tend to be worried mostly about unemployment or unemployment, part of that, and regard unemployment as a bad thing, as most people still do, the monetarists totally turned it upside down. They said, no, you've got this wrong. Unemployment is a good thing. You think, well, how the heck did they come up with that? They said, no, unemployment is voluntary. It's workers choosing to devote themselves to full-time job search to get a better job. And that's what was then called the natural rate of unemployment and is now called the sustainable rate of employment or sustainable rate of unemployment. That both add up to 100%. And it's total bullshit on its own terms and even as a predictive device, because if you ask them, and you've highlighted this, what is the sustainable rate? I'll do it in terms of unemployment. In the 70s, they said, it must be 8%. If we go below that, we'll have inflation again because we're pushing people into jobs they don't really want to soon, blah, blah, blah. So they tried that. And then through the great moderation period of the 90s and through to the global financial crisis, unemployment trended down and down and down and down. And inflation didn't go up at all. So once we'd had the Volcker recession and everything of the early 90s, inflation was hit on the head and it didn't wake up again. So through nearly 2 decades, we had in New Zealand, in America, in the Western world, we had low and stable inflation with a steadily reducing unemployment rate. So the monetarists, instead of saying, we got that wrong, they just kept saying, the natural rate must be 7%. No, it must be 6%. And they just kept lowering it. And now probably, I don't know what the Reserve Bank says, they probably say it's 4 or 5%, do they? Do you know what they say it is?
Well, they say that we are beyond it at the moment. So our 3.4% official unemployment figure from Stats NZ is beyond maximum sustainable employment, is their current view. But they never give a specific target.
No.
So it's an interesting one.
Yeah.
Look, so in terms of, you said that the RBNZ could use some new tools. Obviously, as you say, they're not asking for them, and the government could do more, and you've given that example of the Commerce Commission. Let's start with the RBNZ first, and then we'll look at the government. What tools could the RBNZ use, do you think? What do you think they should have?
I think they're irredeemably lost to moderation here. I think they should be... What they do really well is prudential regulation of the banking system. And they didn't do very well in America, of course, because we had the global financial crisis, but we didn't have a global financial crisis in our banking system, our finance sector in New Zealand. And that's partly because our Reserve Bank is very cautious, and partly because our 4 Australian trading banks, to give them some credit, were very cautious as well. And they didn't issue all these fake, phony derivative type instruments. They were conservative. And we didn't suffer bank failures and stuff as Americans and the British did. And I think that's what they're good at. And I think they should carry on doing that. Of course, they have to set the bank rate, but I think it should recede. It shouldn't necessarily be even something that gets much attention in the press anymore. It should just be more of a technical thing, wholesale money rate, the rate that the trading banks can sort of lodge money in the Reserve Bank. I think that's what it actually means. And that the rest of the economy is looked after elsewhere.
So elsewhere, I assume you mean the government?
Well, I think the government can't just do it. The people have to do it too. I hate that word conversation, but we as a nation have to think about, we don't want inflation, especially if inflation causes the Reserve Bank to put members of our family out of work. But what do we need to agree on then? And one of the things I've suggested is something that used to be called an incomes policy, and is off in Scandinavia where it's, and I think perhaps Germany, it's called tripartism, is where the government gets involved in meetings with the heads of the trade unions and the heads of the employer organisations and the businesses and says, look, here's the information coming out from the Reserve Bank and from the newly invigorated Commerce Commission. It looks like we will have real GDP growth of about 2% this year. Who should get it? How should we apportion it? And could we sort of have targets about how we could fairly distribute that in profits and wages without getting onto this sort of inflationary spiral nonsense that we've been stuck with? So that's something I think we should be thinking about. We can't just leave it all to the government. We have to, as workers and employers, be involved as well.
In your Stuff article, you also wrote about Pharmac, which that sounded sort of quite interesting to me. Can you sort of elaborate? I've got that in front of me here. Yeah. You talked about extending our drug buying agency, the very successful Pharmac, to sourcing other products and services, including medical services, at a lower price from international suppliers. What would that mean in practice? So
I think we agreed. Does everyone know what Pharmac is? It's a drug buying monopoly, a monopsonist we call it, a monopolist on the buying side of the market, and it negotiates prices with the big international pharmaceutical companies for drugs to be supplied, pharmaceutical drugs to be supplied to our health system. I think, am I right about that? Is that what you think it is, Pharmac? I think that's what it does.
Yes.
So it basically says you can't pick and choose and do little deals with some health board and not with another and everything. If you want to sell your products in New Zealand, you have to give them to us at this price. And the drug companies hate it. They often lobby their president, the American one, saying this is surely should be illegal in our trade agreements. But we carry on doing it. It's enormously successful at getting drugs into New Zealand, brand name drugs at generic drug prices. It's terrific. It's by far the most successful anti-monopoly policy instrument we have, far more effective than the Commerce Commission. And so, if it's such a good thing, why don't we try extending it? I mean, even in medicine, we could try extending it to medical services. Some people engage in what's called medical tourism. They go to the Philippines or somewhere to get an operation because it's a quarter of the price. That's a little bit dangerous in many ways, but Pharmac could perhaps do this as well, actually negotiate and take responsibility for pushing down the prices of medical services, which are huge in New Zealand. And then perhaps go further than that, perhaps start buying drywall for building materials, perhaps buying cheap drywall from Australian or Indonesian or Vietnamese suppliers and wholesaling it into New Zealand. I mean, I don't know how far we could go with this, but the idea, it's not a revolutionary idea because we're doing it already with drugs and we're doing it very successfully. So at least why don't we think about extending that model?
Okay, so it wouldn't necessarily have to be Pharmac per se, although your example of building materials, I mean, warm homes initiatives and the health benefits of that, you could arguably, wrap that into Pharmac, but you're talking about doing it in other industries as well.
Possibly, yeah. Or at least finding out why we couldn't,
Okay.
I mean, there's no more powerful foe in terms of market power in the world than the big pharmas, the big Swiss, French, German, and American pharmaceutical companies. They are very powerful, and if we can deal with them, maybe we can deal with lesser powers as well.
So that's a very interesting concept. Look, so very interesting discussion, Tim. Just to wrap up, I guess, coming back to inflation, what is your outlook for inflation from here, I guess, from where we're sitting today? Where do you see it going and why?
Gareth, you're tricking me here. That wasn't on your list of questions you were going to ask. Economists make forecasts, as John Kenneth Galbraith, the economist, said, not because they know, but because they're asked. So I take that as salutary. I hope, of course, it'll carry on going down. But I think it's not something we should. It's something we should be more activist about, making sure it goes down.
And obviously, we've discussed some ways and means of perhaps helping it go down. But you did note in your article that sometimes you just have to wait.
Sometimes you have to wait, but I did note on the article, and I'd like to put this in, that one of the problems with inflation when it sort of kicks in is that some firms, like some agents in the economy, like these big firms, find it very easy to take advantage of and put their prices up, or even just to keep up. But some people, like people living on fixed incomes and stuff, have got no way of adjusting, and they're the poor people. And they are really suffering from this increase in the cost of living, that inflation, which is part of inflation. So I did suggest that maybe it would be nice for the government, one thing it could do is, say, cut the GST from 15 to 10%. That would immediately, overnight, literally, because everything in New Zealand is subject to GST, from rents and mortgage rates, cut consumer prices by 4.9 or 8% or something. It's 5% off 150, whatever. Say 5%, and that would be a real sort of help to many struggling families. And I've tried to do the figures here. As far as I could tell, the boost, one of the biggest single beneficiary of inflation in New Zealand is the government. They get 15% of every price increase in GST. And they also, the inflation in wages pushes people into higher income tax brackets, the dreaded bracket creep, which both our major parties refuse to commit to do anything about, scandalous. So they've probably got enough money in there. You'd need about $10 to $15 billion a year to reduce the GST rate from 15 to 10%. So, hey, Christmas present.
Yeah, indeed. Well, look, Tim, thanks a lot for that. It's a really interesting discussion. That's Tim Hazledine, Emeritus Professor of Economics at the University of Auckland. And I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.